Hello everyone, welcome to today's session in Concept. In today's lesson, we will be diving into volatility. We will be looking into various concepts of volatility, and then I will be showing you some strategy with the help of that you can trade volatility as well. But before starting the video, if you are new here, you can go in the description. There is a link below. With the help of that, you can download and install Concept web application. After successful registration, you will get some free tools in the application that will help you out in your trading. In the application, there is a learn section, so you have to go in the video library, and in the video library we have made multiple videos for you guys, okay, and these videos are available in multiple languages, and these videos are based on Pro Plus tools as well as on various strategies, so you can watch them in your meantime. Now at any point of time, if you guys are having any kinds of doubts or query, so you can directly contact us. You have to go in the support and you will get our contact number as well as email ID, so you can contact us and we will be there to sort your queries out. So let's start today's session, and in today's session we will be talking about volatility, right? So let me write it here. We will be talking about volatility. Okay, now when we are talking about volatility, so there are two terms that we will be covering today, and those terms are, the first one is the HV, okay, known as the historical volatility, right? And similarly the other term will be implied volatility. So we denote it as IV, and that is your implied volatility, right? That is your implied volatility. Okay. Now what the historical volatility is and what is the implied volatility is, so we will be analyzing it with the example. So let me give you an example. So for suppose there is a exam, okay, there is exam and there are two students that are competing with each other. Now for the first student, we have analyzed like the historical performance of this student is averagely 60%. So it means in the past we have seen he only scores approximately 60%, right? Then there is a second student. So this was the first one and this was the second student. Now for the second student, in the past we have seen he generally scores approximately 90%, right? Now in the exam, both of these students wants to score, you can say good marks, approximately 90 to 100% they want to score, right? Now in the past he only scores 60%, but this student scores averagely 90%, right? Okay, now there are some teachers and these teachers are predicting the future, okay, so they are betting on them. Like the first student, he will score 90%, right? So we have seen the performance, like this student is scoring not that much good in the past, but now the teachers are predicting that he will score more than 90% or approximately 90%. It means they are overvaluing him, right? They are overvaluing him. So what will be the winning ratio? The winning ratio will be, so if I'll tell you about the winning ratio, so what will be the winning ratio? The winning ratio will be less. Why? Because his performance was not that much good in the past, right? So we are not sure like he will perform or he will achieve 90%, right? So the winning ratio will be, you can say flat or like this, right? And when we are talking about flat, it means the market will be in sideways direction, right? So I will connect this example with the volatility also. Now there is a second student who scores 90%. Now the teachers are betting on him. They are predicting that he will only score 60%, okay? So what will be the winning ratio of this student? He usually scores averagely 90%. So we know he can score 90% and they are undervaluing him. Okay. So it means what is the winning ratio? What will be the winning ratio of this student? His winning ratio will be greater. His winning ratio will be higher than the first one, right? And whenever this type of situation will happen in the market, so it will show what is the volatility, right? Now let me connect this example with the volatility, right? So when we talked about the past performance, so it is your historical volatility. And we talked about the future percentage, so it was your IV, that was the implied volatility. So what is implied volatility? Implied volatility is nothing but the forecasted, okay? The forecasted momentum that is not actually in the market, but we are predicting it, that this much of volatility can happen. So that is what the teachers were predicting, that this much percentage these two students can get, okay? Now this is the historical volatility, that is the past data that we can actually see. We can see in the you can say in the report cards of these students that they achieve this much of percentage, right? Now whenever Now whenever your historical volatility is less than your implied volatility, right, it means the market do not have that much capability to go, or you can say don't have that much of momentum, right, but we are overvaluing him. Okay, so at that time your market will be in sideways direction, right? So what we got here, we got whenever your historical volatility will be less than your implied volatility, at that time what you will get, at that time you will get this much of momentum, you can say the sideways momentum, right, the sideways momentum. So I will write it here. So HV, whenever it is less than your IV, so at that time what you will get, you will get a sideways momentum, sideways market, right, sideways market. And this sideways market, it is not for the buyers, but it is actually for the sellers. Okay, now similarly, when my historical volatility, so when my historical volatility was greater than my IV, it means the past performance was good. Okay, and now we are predicting that the student cannot score that much. Okay, so we are undervaluing him, so it means the market has capability to go more, it has more momentum. So whenever your historical volatility is greater than your implied volatility, at that time you will see good momentum in the market. So this is the time, this is the favorable condition for buyer, you can say, right? So this is the favorable condition for buyer when they will buy put, or you can buy call, so they will see a good or decent increase their premium, because the market will be in momentum. And if the scenario is something like this, so at that time if you will buy a call option, or if you will buy a put option, so at that time you will not see that much of momentum in your premium. Okay, so if the market is moving up but it is not that moving with that much of momentum, so your premium will not be increasing. Okay, so this is one of the things that you have to analyze. Now I hope the concept is clear. Now let's see how we can use this concept in the concept application. So for that you have to open the concept application, and in the analyze section you can see we have a proper section for IV, implied volatility, that is. Okay, so we will directly go here in the IV HV, that is the implied volatility, and the historical volatility, so that is the second option. So I will click here, and then we will go in the IV minus HV. So when I go here, okay, when I'm here at IV, that is implied volatility minus historical volatility, so at that time I'm getting this graph here. So there are some lines, you can see those are in red color, and then I can see there are some lines that are in green color, right? Okay, now we got a concept, okay, that whenever your historical volatility will be less than your implied volatility, it means the implied volatility is greater, the historical volatility was not that great. Okay, it means the historical performance was not that great. So at that time you will get the market in sideways direction. I'm revising your concept, okay, please. Then whenever your IV, that is implied volatility, it is less than your historical volatility, so at that time what I will get a good momentum in the market. Okay, good momentum in the market. And on the basis of this concept we have made this tool here. So you can see this is the difference between IV minus HV. This is the difference between IV minus HV. So you will analyze IV minus HV here as well. Okay, so it will give you a definite value. Now see, whenever your IV is greater in the sideways market, it means whenever your IV minus HV will be positive. Why will positive? Because we are subtracting historical volatility from the implied volatility. So at that time my IV is greater. So if this value will be positive, at that time what you will get a sideways market. Okay, and whenever this value will be negative, okay, so it is showing me negative, it means the IV minus HV, it is showing me a negative value. It means the historical volatility is greater than the IV. That is the concept we got here. Okay, so this means the market will be in momentum. Okay, so what we are getting here, whenever the IV minus HV will be negative, at that time the market will be in momentum. Whenever the IV minus HV will be in positive, at that time the market will be in sideways direction. Simple. So I hope the concept is clear. Let's see how we can use this. So right now you can see I am using the chart of Bank Nifty, and I am analyzing the IV and HV of Bank Nifty. Now you can see currently there are some green lines. So whenever there is a green line, it means the IV minus HV is positive. Okay, so you can say it is positive. So your green bars will denote a sideways market. Okay, whenever there will be green bars, it means the market will be in sideways. Okay, now whenever your IV minus HV will be negative, so it will be denoted by these red bars here, and it means the market will be in the momentum, right? So I hope the concept is clear here. Whenever the bars will be in red, it means there is a momentum in the market. Whenever the bar will be in green, it means the market is in sideways direction, right? So let's see how we can use this concept here. So you can see in the current market, in the current scenario, the most of the market was in green, okay, and then currently in the recent scenario we are getting some red bars here continuously, and then at time you can see the price is also showing me a good momentum in the market. So you have seen the bank nifty and nifty, they are currently in the momentum, they are falling. Okay, so that is what we are getting from here. Okay, now if I'll show these green bars here, so you can see whenever there are some green bars, at that time your market was in sideways. Okay, when I got some red bar here, so at that time you can see the price was increasing, so you can say the price was in momentum. Okay, when we got some green bars, so you can see the market was in sideways. Okay, then we got a red bar, so you can see then you got a momentum here, you got a momentum here as well. Okay, so this is how you can interpret your HV as well as IV. Okay, now the concept is what are the strategy that we can apply when the market is in sideways or when the market is in momentum, right? So what you will do, let me directly take you to the trading, and then we have to go in the option architect, and let's go in the custom, right? Now whenever your market is in sideways direction, so that is actually a market for the sellers. So for seller, what you can do, you can go here, and in the either ways you will get a straddle or strangle, so you can apply this strategy for you. Okay, or you can just make short straddle for you. Okay, and you can go with the short call condor, you can go with the short iron butterfly as well, right? Now when I'm talking about buyers, okay, what are the strategy that the buyers can apply when the market is in momentum? Okay, so the first one is they can go with the naked call or naked put, but that will increase some risk there. So if we want a good strategy that will hedge our position as well, so what I will do, I will go here and I will go in this trap. Okay, so when I will go in the yes, so you can see what I have done here. I have bought a call option. Okay, because I am having a view that the market will show a momentum, and I am a little bullish. Okay, I'm not that much bullish, but my sentiments are a little bullish in the market. Okay, as comparison to the bearish. So what I will do, I will buy 2 lots of call option. Okay, at the same time I will buy 1 lot of put option. Okay, it means I'm giving more weightage to the call option because I'm buying 2 lot of it, and what I'm doing, I'm buying ATM call option. Okay, so the name of this strategy is strap. So when I'm going with this strategy, what is my view? My view is bullish. Okay, bullish, but not that much of bullish. Okay, but I know the market will be in momentum. There will be momentum in the market, right? So it can go in the bullish side, it can go in the bearish side, I don't know, but I'm little bullish from my side. Okay, so what I will do, I will go and I will buy ATM call option 2 lots. Okay, at the same time, I don't know if the market will go against my view, against my interpretation. So at that time, for the hedging this position, I will buy ATM put option and I will buy 2 lot. So at any time, if the market will go against my sentiments, if the market will go in the bearish direction, so at that time the ATM put option, I have bought 1 lot, so this will hedge my position, right? So this is one of the strategy that you can apply, right? So this is for the bullish sentiment, a little bullish sentiment. Now there will be times when a buyer will say there is a momentum in the market, there are some red lines. Okay, so at that time I have to go for the buying, but now the buyer the sentiments of the buyer, you can say, they are a little bearish. Okay, so at that time the strategy I will select, so I will go directly in the select strategy inside either ways, and I will go for the strip. Okay, and then confirm. Now in strip, what I'm doing, so what I will do, I will go and buy ATM put option. Okay, ATM put option, and I will buy 2 lot because I am having a little bearish sentiment in the market and I know there will be momentum, right? So I will buy 2 lot. At the same time, I will buy ATM call option for one lot. Why? To hedge my position in case the market will go against my direction and I know there will be momentum in the market, right? So at that time this ATM call option will hedge my position, so I will buy one lot of it, as you can see here. Okay, so I will also show you the payoff as well. So this will be my payoff. So if the market will go against my direction, in my direction, okay, with my sentiment, so at that time I'm getting a good profit. But at the same time, if the market will go against my direction, so at that time again I am having a good profit here as well, right? So this is, you can see, this is how you can make your strategy whenever there is momentum in the market and you are having a little sentiments of one side, but at the same time you want to hedge your position, because if there will be momentum in the market, so if the market will go against your direction, so at that time you will face a good loss, right? So that is why we want to hedge our position. So I think I am done for today's topic. I hope you got to know something good today. आपके concept clear हो गए होंगे. अगर आपको मजा आया, you can like the video, you can share it with your friends as well. अगर आप नए हैं तो make sure you subscribe as well. Okay, thank you so much. This is your trainer Ankit Singh Rawat. Have a good day.